Next is deferred. So learning objective 2, deferred revenues, sometimes called unearned revenue. Both are very descriptive. In most of the cases, revenues are not deferred. In retail, back to Starbucks, you pay for that cappuccino when you get it. So that's cash almost immediately upon receipt of your coffee. Business to business, or B2B, is often done on credit. A customer buys a product, the seller delivers the product, and there's a 30-day period in which the customer should pay the seller. So those are normal commercial terms. However, we have these cases where the money is paid in advance, and these are deferred revenues or unearned revenues. So an example is something you owe customers. So one way to think about it is somebody gives you, let's stick with licensing. So somebody gives Microsoft $120,000 to use Microsoft software in their entire corporation for 12 months. Well, when that $120,000 is paid by, say, IBM to Microsoft, Microsoft didn't yet earn $120,000. It's going to earn 1/12 of it each month that the license covers. So 120,000 divided by 12 is 10,000. On that particular transaction, Microsoft can count $10,000 per month. And in the meantime, it's recorded as a liability. So the first entry is Microsoft gets 120,000 from IBM for the 12-month license. Cash goes up 120,000. Revenue does not go up at all at that moment, but unearned revenue or deferred revenue, both are variations of liability accounts. It sits there as 120. Then end of January comes, and then we reduce the unearned by 10,000 and we increase our revenues by 10,000. February comes, same thing. You further reduce the liability account by another 10,000 and you further increase revenues by 10,000. By the 12th month, by December, you would have taken out 12 times 10,000 or 120,000. At which point the unearned revenue drops to zero and the full revenue is included for the year that you're in because you have 12 months at 10,000 each. So that's an example of deferred revenues. Another way you can think about it is somebody gives you $120,000 and you're supposed to give them something back. If for some reason you don't give it back, you need to refund that money, right? So it's kind of like a liability until you deliver. So that's another way to think about it. Why is it a liability? Why do you owe anybody anything? Well, in the event you can't deliver, common sense, maybe the law might be slightly different on your contract, but common sense would be giving back the money. You didn't deliver anything. An example, using some numbers, is that we have this case where we get money. So in this case, we receive $400 in advance for iPods. So cash goes up by 400 and a liability for unearned revenue goes up by 400. Next, we ship some, or in this case, we ship it all. So at that moment, as we said with any product sales, there's two pieces to it. First, let's recognize the revenue. So we're going to increase the revenue by $400, and we didn't get cash because we already got it. So you reduce the unearned revenue by 400. So you get rid of the liability by giving the customer the product. Now that product didn't come out of thin air, so you have to reduce inventory by the cost of goods sold for what you just provided to the customer. In this case, it's $150. So cost of goods sold goes up by $150, which is a negative $150. And you're going to reduce inventory because you now are missing some inventory because you just sold it. So you have a negative inventory of $150. Next, we're going to look at unearned revenue from the standpoint of reporting. So we see it in the liability section, and in the notes to the financial statement, they provide what's called a reconciliation. And reconciliation, again, means you start with a number, you end with a number, and tell me how it got from there to there. In this case, we had a beginning balance, and then we added to deferred revenue because people gave us money in advance. And then we had recognized revenue because we delivered the product or service to the customer. And then that ends up with the ending balance. You'll notice that growing revenues that have deferred or unearned revenues, that's kind of a watch point for the company's health. So if the company continues to grow, this deferred revenue will keep going up and up and up because the new people giving in money will be more in dollar amount than the older people that have been sitting around for a while. So as you grow, this account tends to grow. And that's why, again, Microsoft has a huge number in this particular line item because they've grown very dramatically in the past and maybe less dramatically, but nonetheless still growing even today. So this is the quantification of that Microsoft example. and it's $22.4 billion in 2013. And so they explain how does it happen. Here they describe the revenue recognition, and it describes in longer terms what I told you earlier, that if companies pay partial of hardware and software, they split it. And also, if companies pay for things that are over a certain period of time, it's recognized over that period of time. So that's what this slide illustrates.